right, welcome everyone. We are so excited to be on to talk about like this topic today. I know credit evokes a lot of different response and feelings, and we acknowledge that. And so when we do like different webinars on credit, like our aim, of course, is to always provide you with up-to-date and relevant information that will help you with like your credit management. So I'm going to start off with like introduction, let you know a little bit about who we are. My name is Kamaya Walls-Bichard. I am a consumer economics educator with University of Illinois Extension. I am currently in Normal, Illinois, where it is sunny outside, but it's kind of cold. I'll hand over to Natalie as she will introduce herself.
Sure, thanks, Kamaya. My name is Natalie Daniels. I manage the financial fitness program, which is our financial wellness program at DePaul University. I am here in Chicago, Illinois, where it is also sunny and beautiful and rather cold. Thanks.
And you may have heard me earlier. I'm Andrea Pellegrini. I run the University of Illinois Systems Student Money Management Center, and I am currently in Champaign, which is also sunny but cold.
Thank you, Andrea. We're always so happy to have you on doing all these administrative things. The next question I have for you is, tell us where you're logging in from today. I saw that one person said that they were from Hudson in New York. Let us know in the chat where you're logging in from today. I see Champaign, Urbana, Fisher, Pontiac. Ooh, Minnesota's on here, St. Paul. Well, continue to let us know. Put those in the chat. We're so happy to have you on. Like Andrea said, we have a lot of content to cover today. So I'm just going to jump right in and let you know what we'll be covering today. So first, we're going to look at just the credit system and the different pieces that are involved in that. Then we're going to look at the role of a responsive borrower. So different people, like what their roles are within the credit system. And then we're going to cover some myths and facts about credit. This is always a fun one for us. And thank you so much, Andrea, for this awesome unicorn right here. Then we're going to look at some definite steps to build in like a positive, a healthy profile, and then share some resources with you as you think about like maintaining like healthy credit habits. So understanding like your role within the credit system, like who you are as the consumer and how you fit within that system. The first question I want to ask you about this is, what comes to mind when you hear the word credit? Or how would you define it? Again, we love when you share in the chat. So please go ahead and put some notes in the chat for us. What comes to mind when you hear the word credit? I see anxiety, credit card, using someone else's money, credit score, money, borrowing, loans. So yeah, different things. I see flexibility in here. So I'm hearing a few different things. All right, continue to add those. So a few different things come to mind when we hear the word credit. And I always like to start out with kind of a definition. So we're all starting from the same place. So this is one of my go-to definitions for credit. So credit, money borrowed, provide to you as a loan so that you may purchase goods or services when and as you need them. So a big part when we're thinking about credit is that loan that has like that interest that is provided to you for your convenience. And I saw somebody said flexibility in there as well too. And of course, with like obtaining credit, that's based on like your past financial behaviors. And we'll talk a little bit more about that. Other things that come to mind when we think of credit has to do with money that you can obtain from a bank or business that allow you to use it now. And then of course you pay that back in the future with interest. So lots of different ways in how we think about credit. And Kendra just shared a resource in the chat for you. So for us, as we're going through and we're talking about different things, if you want to see those resources immediately, you can find some of those in the chat as we're going along. We're going to be sharing those. So yes, lots of different ways in how we think about credit, right? And so when we are choosing credit, what are we thinking about when we're choosing credit? And a big part of this is kind of knowing what your goals and your values are. What are the things that matter to you? and how can credit help with like obtaining those goals, and trying to decide if it's like the right tool for you. When we think about credit, a lot of us have lots of different feelings, and we'll talk some more about that later on. But just making sure that it is the right tool for you and you're choosing it for the right reasons. Also looking to see like what are some of the benefits, what are some of the challenges that might come out of using credit. Just understanding who you are and how you manage money, maybe your money personality, just different experiences that you've had with handling money and credit in general. Just trying to understand what all of those are as you're making like those decisions to choose credit. Now, true to the title of this workshop, we wanted to focus on like credit awareness. Like, what does that actually mean? So when we think about the credit system and where we are positioned within the credit system, just trying to like understand like our roles and what we need to know about it so that we can make like the best decisions for ourselves, and knowing where to find like the accurate information that is up to date. So making healthy credit choices requires kind of like that general awareness of kind of like the system itself, like how does it work, what's the overarching piece with that, and then who we are as a consumer, as a borrower, and where you fit within the credit system. So as we develop like our knowledge base on how the system works, we start to understand like our responsibilities and our role within it. So looking to see at like the environment versus yourself. So within like the credit system, and we'll go into that a little bit more, knowing like the right questions to ask, like why are you obtaining this credit, what you need it for, like understanding like what are some of the strategies for managing credit, and knowing that there are agencies that regulate how credit is handled. So how you can apply for credit and how lenders or creditors distribute that. And yourself, like understanding a little bit about how do you check like your credit history? What do you need to know about like your background before you consider obtaining any credit? And also to understanding like the overall impact of credit on your financial well-being, and knowing that as a consumer you have rights that are there to protect you, rights that are in place to guide the behavior of lenders and creditors. So just wanted to talk a little bit about that, and then I'm going to bounce it to Natalie. We're going to do a little bit of flip-flop here, so I'm going to bounce it to Natalie as she talks about what I've been hinting at, the credit system. So she'll give you a little bit on the basics of that.
Thanks so much, Kamaya. So yeah, Kamaya's been talking about credit as a system, and it really is. It's a way of rules that kind of regulate and impact and influence the way we interact with creditors, and the different interest rates we're given on potential financial services. So I want to start at the beginning. So different companies report your payment history to your credit bureau. So that could be your cell phone company, your landlord potentially, your utility companies, your mortgage, car loan, any of those. They're going to report your payment history to these different credit bureaus. And we'll talk about those a little bit more shortly, but the main three credit bureaus are Equifax, Experian, and TransUnion, and they will generate these credit reports. And those reports contain a record of all your payment history, as well as some other information, balances on different credit accounts, length of accounts, those kinds of things. Those credit reports are then used to generate your credit score. And those are numbers created from data in your credit history. Later in the presentation, we'll get into a little bit more detail about scores and scoring models. But that number is then used by different lenders, different people that you're interacting with, in order to assess your credit worthiness. So the higher your credit score, the more credit worthy you're said to be based on these different consumer companies that are potentially looking to work with you and impacting the costs of many of your financial services. So it all kind of works in a slide together. And to go into the different credit bureaus a little bit more, can we go? Thank you. So these are the main three: Equifax, Experian, and TransUnion. And each of these are getting very similar information about you. Like we're saying, those different industries are reporting to these credit bureaus, but not every company is going to equally report to each credit bureau. And then each credit bureau has a slightly different formula as far as calculating your credit score. So you will see your credit score differ at each of these bureaus based on their own formula for calculating that score. And each company has their separate reports. Your report may look different at each of the credit bureaus. And again, because different companies are reporting to potentially all or maybe only some of those credit bureaus, you may have slightly different information listed on those reports as well. Now to talk about your credit report versus your credit score. So these are seemingly, sometimes people think they're the same thing, but they are two different things. So again, your credit report is a written report compiled by one of those three credit bureaus. It shows your credit history. It shows your open accounts. So you can use this to verify your own personal information. Make sure there are no accounts on your credit report that shouldn't be there, which can help prevent identity theft. You can get a free report from each of those credit bureaus every year through annualcreditreport.com. Some people tend to request those all at once. Some people kind of stagger them throughout the year. So you have that free report that you could check every 4 months or so if you're going by each of those different credit bureaus. And then that credit score is that raw number that different lenders are seeing or different companies are seeing to assess your credit worthiness. The main range for your credit score is between 300 to 850. That's the FICO score, but there is a little bit of variance there depending on the type of score that you're pulling and if you're pulling a FICO or a Vantage score, which again, we'll talk about a little bit more later. This score is used by lenders, landlords, sometimes even potential employers to determine if you are a risky person to lend money to get to lend or to let an apartment to, or potentially to let a job to. And I always encourage you to use free resources to check those scores. So if you do have a credit relationship with someone, you may always also see a free credit report from maybe a company you already have a relationship with. And there's also other free services out there as well. And yes, Donna, thank you. That's great. I'm going to turn it back over to Kamaya to talk about the credit invisible.
Thank you, Natalie. And yes, to address, there's a comment in the chat from Donna. Yes, you can access like your credit report weekly due to the coronavirus pandemic, and that goes until April of 2021. So thanks for sharing that in the chat. And so as we're going along, we have like a lot of different educators, professionals on here as well too. So if you have questions or comments that you want to share in the chat, please go ahead and do that as we're moving along. All right, credit invisibility. Believe it or not, this is one of my favorite things to talk about when it comes to credit and credit management. I am excited to talk about this. So a 2015 report from the Consumer Financial Protection Bureau indicated that approximately 26 million Americans do not have any credit history with at least one of the three primary credit reporting agencies. So those are the agencies that Natalie just talked about. And an additional 15 million people had what they call unscorable credit files because their credit files were too thin. And so they didn't have like sufficient amount of information on there to kind of assess like their background. So since lenders use our credit history to decide our credit worthiness, as we've been talking about, people who fall within this category may face a range of issues when it comes to obtaining credit. So when it comes to things like even leasing an apartment. So what this means is there are millions of people that are credit invisible. And this, of course, is for a wide range of reasons. So I have another question for you. Again, I tell you, I love this chat. Another question that I have for you. Why do you think some people are credit invisible? Why do you think people have such thin files, or they don't have any information with any of those major bureaus? I would love to hear from you, some of your comments in the chat. Some people choose not to use credit. Yes, absolutely. Some people prefer cash. Some people are scared of credit. These are some of the responses I'm reading. I see one in here that says religion. Muslims aren't supposed to borrow with finance fees. I'm not sure. I've not heard that before, but that's very interesting to hear. Another piece, lacking information or resources. Too young, haven't borrowed. Divorce. So a lot of different reasons why people might be considered credit invisible. So with the report from the CFPB, there are a number of reasons that come out of this and a lot of efforts to try to increase the visibility of a lot of people. And the report highlights just like discrepancies that they see within the population. So the report indicated that Hispanic consumers, Black consumers, and consumers in low income neighborhood are more likely to be credit invisible. And this is for a number of reasons. So just looking at what are some of the things that contribute to invisibility, some of it is like debt aversion. So people are just like one of the first comments said, it scares you. You don't really care much for it. You don't want to go into debt. And so for some folks, they might have like a negative view of debt. And that could be because of others that they've seen use debt in their lives or just different myths or misconceptions that they have heard about debt. A lot of different reasons why they choose not to use that. Some also think that others may use it kind of irresponsibly. And I read an article from the Charitable Trust. I can't talk right now. Sorry, everybody. And they were talking about just like some of the different reasons why groups like millennials might be more kind of debt averse. And so looking at to see like what are some of the reasons people are given why they're choosing to not use credit. So one of it is believing that others may use it irresponsibly and people are living beyond their means. So just like different ways, just based on how we were raised, like the values that we have, the different things and how we feel about what debt actually means. So that's just one of the things that are one of the category of things that might contribute to like that invisibility. The other piece that I want to talk about is that unequal access to credit. And this covers like some of the discriminatory practices that might affect some groups more than others, like pushing people into that category of invisibility. So I'm going to touch on three of these. So when we think of like overt discrimination, this is when individuals get treated openly differently than others based on some prohibited basis. So based on race, gender, age, and we'll talk a little bit about those protected categories in a little bit. So the other one is disparate treatment. And this is when someone applies for a loan. So an applicant is treated differently based on those protected categories again. And this could be subtle or it could be obvious. So people in this situation sometimes might see it kind of openly, and then other times it's a little bit more subtle. And the last one is that disparate impact. And this is when the lender kind of applies like a neutral policy, but that policy kind of disproportionately affects individuals within a certain group. And there was a great article from the Consumer Report that talked about like one of the nation's leading insurers that implemented a policy to increase like insurance premiums. And what happened was they used like an algorithm to just assess risk, to look at a lot of different variables. But what they found was that it actually negatively affect middle-aged drivers more. So middle-aged drivers ended up paying higher premium than other drivers because they use like the algorithm to try to get it all set up. But what it actually does, so they try to use like this neutral policy that should apply to everybody, but it just disproportionately affected middle-aged drivers differently than the rest of the population. So just different ways that or different factors that will contribute to people being credit invisible, and that debt aversion versus the unequal access to like credit are factors that affect that. All right, so go ahead and ask your question, put your comments in the chat. I'm gonna talk a little bit about just credit protections and responsibilities. And a big factor when I think about like just like the different pieces that affect like our lives, and what are some of the protected categories that we have that will help us as consumers make like the right choices. If you want to go on to the next slide, Andrea, that'll be great. So we've been talking a lot about credit, and once we talk about like credit invisibility, it is very important, of course, to talk about just like consumer protection rights, right? So different things that protect us as consumers, and credit discrimination and having like that lack of credit history can have like an impact on like your financial future. And so while we may not see a lot of people saying they've experienced maybe like credit discrimination, these protective factors are here just to prevent that from happening and trying to make sure that everybody have fair and equal access to credit. So some of the protective factors that are in law are categories based on like your national origin, your race, your religion, your housing, education. A lot of these factors that uh, are there to protect us as consumers. Now, lenders, of course, we'll have to use information such as our income or expenses and the amount of debt we owe, the credit history, all of that. They have to consider all of this when they're deciding to lend us money. But what they cannot do is use like these protected categories as factors in like their big decision making. So creditors can definitely ask you questions. They need to know that you're going to be able to pay them back. That's an important piece with like lending that money, but they cannot discriminate based on these protected categories. All right, I see some activities going on in the chat. Thank you to my co-host for answering some of those questions. So, you know, I talked a little bit about like the credit invisibility piece. So how do we kind of flip that? How do we kind of change that? It's hard to change when folks have like those very strong values and determination that they're not going to be using credit. We're not here to change that. Part of the job, my job, what I think about when I think about like credit invisibility and talking about this topic is just to present like just these different point of views and these ideas of how like agencies like the Consumer Financial Protection Bureau have addressed issues of credit invisibility. So to become credit visible, what do you need to do? So without a credit record, lenders will have a hard time assessing your credit worthiness. And I swear, like me and the S's today, so I apologize if my S's are sounding weird. So trying to assess like your credit worthiness can be very hard. So for a lot of people, like one of the most popular product that's used to try to help people become more credit visible is credit cards. And one of the reports that I read says that 15% of consumers open their earliest credit account with a co-borrower, and that just means like a co-signer, somebody who is going to be on that with them, and somebody who is able to kind of back them a little. So for young folks who are starting out, that is one way that has helped. Or for people who are trying to rebuild like their credit, like having that trusted ally as somebody who is there for you to help you through that, and to be a co-signer on like that loan or with that credit card is one way to help that. Another way is a lot of efforts is going into play to make uh, alternative data use more available, and so that people can use like this information. And so for alternative data reporting, just like your good financial behaviors. So for example, having like your rent payments, your cell phone, your utility payments, like that type of information being reported to say, yes, this has been a good consumer and you can trust them to pay back their bill because you're trying to build credit or they're trying to rebuild their credit. So here is a history of other things that they're doing outside of some of the traditional information that you would find on like your credit report. So those are just a couple of ways that a lot of protective agencies are working to help build that, to help get more consumer information, just to show like good payment behaviors that can influence how they borrow and the rates, interest rates that they do get. All right, I see more activities going on in the chat. Wonderful. Now I want to talk a little bit about different types of responsibilities. So we've been talking about the credit system, and we have different levels within the credit system, different people within the credit system. And so when we think about like lenders, they are required to provide us with like fair, and equal lending practices. So of course, like having like the right information for us, so clear policies of what their expectations, what their goals are, and just like guidelines for their loans. And also part of their job is to definitely make sure they are doing kind of like a proper analysis of consumer background. So they're looking to see, will this person be able to pay me back? So making sure that they're engaging in those practices. They're also responsible, of course, to provide effective customer service. So having like their contact information, like having that information available for people to access easily, and information that is going to be relevant to the consumer. So a big part of that is making sure that they keep consumers informed when they made any changes to their loans or any other types of changes. So making sure that they keep people up to date on what all the different changes are. So if people are having maybe a hard time with like making payments, they will know who to contact and the right information, or the right person like within the service to contact. So just having like the right terms and the right information within like their policies. So in addition to lender responsibilities, is what are your responsibilities as the borrower? So you are going into this and you're making like your decision. So what we call like that personal finance due diligence. So think about like what you can afford. Like what can you afford, and understanding like what your needs and your desires are and how you handle money. And sometimes it's hard when we're thinking about how we handle money, because that sometimes develop over time and we're getting to know ourselves. But just trying to think a little bit deeper about who you are, what your needs are, and making sure that you're paying attention to that. Also providing updated and correct information to your lender. So if things change and they have like the wrong email address, or you moved like 3 times already and your right address isn't on their files, like that, any new information that they're going to be sending is going to go to that old address. So just making sure that you do your part in keeping like your information up to date. You also have like the responsibility of paying back what you owe. So understanding the terms of your loans, like what your interest rates are, if it's going to be fixed, if it's going to be changing, just understanding like the different pieces there. And then paying your bills on time. And if you do have like a co-signer, that co-signer has that co-signer responsibility piece, knowing what that actually means, meaning that if you do not pay that back, your co-signer who's trusted you will be liable for repaying that loan. So just like lenders have responsibilities, so does the borrower, and so does co-signers. So for our wonderful co-signers, I've had co-signers in my life before, and that has helped me wonderfully. But I knew when I was younger, I didn't fully understand what that meant. So what that actually means is the co-signer takes responsibility for the repayment of the loan. So if the borrower stops making payment on that loan, the co-signer will be responsible for that. And think about going in it, if you are the co-signer, if somebody else is co-signed on your loan, just knowing that the co-signer, um, them signing onto your loan will affect like their ability to borrow in the future. So if the borrower just defaults on loan or miss payments, like that can show up on like that co-signer's history, and so that can affect them if they have like other things that they're going to be doing. So whether they're trying to take out a new student loan or buy a car, all of that. So that's a big consideration, and we always like to add this piece in as we're talking about like credit management and understanding roles and responsibilities. All right. I've been talking a lot and I see a lot going on in the chat. I always like covering credit because I know there's always great discussions. So thank you all for that. My other piece I want to talk a little bit about is the Credit Card Act of 2009. And if you've noticed, we've been including a lot of the consumer protection piece as we're going along for like the different parts that we're covering. So the Credit Card Act of 2009 provided like more provisions so that it provided more protections for consumer. So under the Card Act, it allowed for more transparency and more visibility. So before, in a report from the Consumer Financial Protection Bureau, it stated that before there wasn't so much transparency, but the Card Act made it a lot more visible. And so it made shopping for a credit card, comparing like the cost more straightforward. And so it allowed for consumers to see what they need to do ahead of time. And so they can shop around more. And one of the key things that I want to highlight from this, we have a few bullet points in here, but one of the key things I wanted to highlight from this was that under the Card Act, issuers or credit card issuers were kind of prohibited from opening new accounts to anyone under 21 unless they had like an adult co-signer or that person could show that they show proof that they could make payments or they could repay that. So a big part of this act was like that greater protection for young people as well, and a lot more transparency and restrictions on how like issuers were able to provide information to consumers. So I just wanted to touch on that just a little bit. My other responsibility party that I want to talk about are loan service, and I just want to really touch on this before I move on to a next question. So when we think about like the different responsibilities as they pertain to like credit and to loans, it would be hard not to mention like loan service. So this, of course, is a company that handles billing and other services on your loan. So since loans have the right to service them, can be bought and sold, you can pay it, sorry, but what I want to say about the loan servicer before I read through this is with your loan, just thinking about like there's a different responsibilities, like your loan servers also have different responsibilities. They have kind of like those administrative role in like helping to manage your loan. So they will deal with like the payments, the tax, the insurance. So if you have like an escrow, for example, with your mortgage, so the loan can be done by like a bank or financial institution or even like a non-bank agency. But just knowing that with your loan, you might have like a loan server with them. So they just have like some different responsibilities there. So I just wanted to briefly touch on that. All right, I've been talking a lot. So I'm going to stop for a second and ask like a question. So what are some common issues consumers run into when establishing credit? So I saw some things going on in the chat. I'm going to take a brain break right now and just watch the chat to see what ideas you have. What are some common issues that consumers run into when establishing credit? All right, it looks like there was some other discussion going on. Not using different kinds of credit, selecting the best credit card, lack of existing credit, they're denied credit cards. Good. All right. Well, thank you. Oh, that is some good comments. So my other piece that I want to talk about are just like some of the common issues and go through a few different things before I hand it back to Natalie, because I'm sure you really want to hear from Natalie now. But some of the common issues that we face, of course, is, like not enough like credit history or being denied like your credit application or even experiencing like fraud and identity theft. So when these things happen, what can you do? What can you do as a consumer? What makes sense for you to do and try to figure out? So with like that lack of credit history, we talked about like just some of the different things to become more credit visible. Trying to make sure that you make your payments on time, If you are having like issues with that, like talking with your lenders. Another piece, of course, is being patient. Like building credit, it does take time. If you find out that somebody has been using like your personal information to open like different accounts, just making sure that you are disputing like any errors that you see, or you are reporting like that information to like the credit bureaus. So if you pull your report and you see any errors on it, you are of course addressing that. And if you are looking at your accounts and you see that there is some discrepancies there, just making sure that you are contacting whether it's your lender and of course like the reporting agencies to report like any of those that you might see on there. So there are different issues that you might face, but just making sure that I know we're all super busy and a lot going on right now, but if you see like those errors, make sure that you're addressing them and before things kind of escalate. So say you were denied credit. What is that all about? So, what happens when you're denied credit? So first thing, you're supposed to, of course, receive like your notice. You're supposed to receive an adverse action notice, just letting you know that you've been denied credit. And in that, you should see, kind of like why you were denied credit. So what information they pulled from like your credit report, and which of the credit bureaus did they actually pull that information from. So if you remember when Natalie was talking about like the different bureaus, yes, they receive similar information from you, but they're separate agencies. And so just making sure that when you get that information, it does have that credit bureau's information in there, so their contact information, so that you can inquire as to why you were denied. So when dealing with like a denial, absolutely try to find out why. And of course, that is through that letter that you will receive. You can then review like your credit report for any errors that might be on there, see if there's like any inaccuracies, if there is anything that's showing that there's fraud, people opening accounts in your name. And of course, consider what you want to do to make sure that you are monitoring what's going on with like your credit history. The other piece, of course, when you're denied, it can be devastating, it can be disappointing, but always remember that there are ways that you can, of course, try to improve your credit worthiness in the future. And on-time payment is one of the biggest factors. So only apply for what you need when you need it, and not more than that. So just different ways of dealing with like a denial. All right, well, thank you. That was a lot of talking from me there. Now we get to answer some questions. I'm excited about this. Over to you, Natalie.
All right, thanks, Kamaya. And for this, we can just see maybe people typing myth or fact in the chat. We're just going to go over a couple different common credit myths. I'm happy to do this fun point with you. And yes, thanks again, Andrea, for these unicorn graphics throughout. We love the unicorns for the myths and facts. All right, so our first one is you start off with a credit score of 0. What do y'all think? Is that a myth or a fact? Myth. Okay, good. So we have most of the people are saying myths, a couple facts in there. And usually, again, credit scores typically range from about 350 or 300 to about 900, depending on the scoring model that's out there. So it's very unlikely that anyone's going to see a credit score of 0, because that's just below where the scoring ranges usually start. All right, what's our next one? Having a credit card means you will be in debt. Myth or fact? Okay. Cool, we're seeing a lot of myths there as well. And yes, you all are right. That is a myth. You can have a credit card without carrying a balance or maintaining debt. We had someone in the chat talking about how they're paying their credit card off every month and having that no debt associated with their credit cards. You certainly can build good credit, pay it off in full every month, and not carry a balance or have a debt load on there. It's a wonderful myth. All right, let's keep going. you have multiple credit scores. Yes, facts. Okay, cool. Yes, definitely facts here. And we've been talking about this a little bit too. So different companies create and sell credit scores based on your data. And you might have a different credit score for an auto loan versus a home loan versus your typical basic FICO score. All of these can be slightly different. So there are a lot of different credit scores out there for people. Charging high amounts on your credit card will help your scores, plural. Myths, so great. Yeah. So the more available credit you have when your credit score is pulled, usually that means that you have a lot of available credit. That means you have a higher credit score. So that's your credit utilization ratio. They look at the amount you have charged versus the total credit limits you have, and keeping that ratio nice and low, usually below at least 30%, is a great way to maintain a high credit score. All right. Checking your own credit score will lower it. Cool. So we're seeing a lot of myths here. And this is something that I see come up so often. So I'm happy to see a lot of myths here. So if you check your credit score, it's considered what's called a soft credit inquiry. And because it's your information, you have the right to look at it. And other people who also have credit relationships with you can do soft inquiries as well. So for example, if you have a credit card with a bank, that bank can look at your credit score and they may use that soft inquiry to offer you a credit limit increase or something along that line. But if you're asking for credit, so you're asking for a credit card, you're applying for an apartment, you're applying for a car loan, something like that, that's a hard inquiry and that can have an impact on your credit score. And this next one actually, I think, came up in the chat a little bit. You should close credit accounts you don't use to help your credit score or scores. Okay, so I'm mostly seeing myths come through here. It's nice. And that is a myth, but again, there's a little bit of nuance here for this one. So when you close an account, it can reduce your available credit, which can then impact your credit utilization ratio, right? So if you had 2 credit cards and they each had a $1,000 credit limit and you had $500 on one card, but you closed one, then you suddenly have a 50% credit utilization ratio on that one remaining card. So sometimes lenders will look at available unused credit as risk too when they're thinking about whether or not to lend to you. It's important to pay attention to that. And this next one, interest rates on credit cards and loans are determined by credit scores, myth or fact? Yeah, for sure. That's a fact as well. So those credit scores are that numerical representation of your credit worthiness or how likely you are based on this number to repay your debts. So that can determine whether or not you qualify as well as the interest rate you will receive. This next one, I think we saw a little bit in the chat about as well. You don't need to carry over a balance to establish a credit history. Yeah, I see those coming in. That is also, yeah, a fact. So the biggest factor in determining your score is your payment history. Generally, you never need to carry over a balance to maintain a good credit history. It's always the best thing, in my opinion, to pay it off in full whenever possible. So thanks for playing. That's a good, nice, fun way to get some interaction going and to think about what we've talked about so far. And then let's segue into the different types of credit that are out there. So these are our 4 main types of credit. We have our secured credit, our unsecured credit, revolving credit, and installment credit. I'm going to talk a little bit more about revolving and installment shortly. So I'm going to focus on secured and unsecured here. So your secured credit, essentially that means there is a tangible piece of collateral that is put up for the borrowed funds. So the easiest thing to think about, like a home loan or a car loan, potentially if you are defaulting on those loans, that home or that car could be seized. Unsecured credit, essentially you are making a promise to pay back those funds, but there's no physical collateral that the lender could take back from you if you do not pay the funds back. So most credit cards, although not all credit cards, are unsecured. Your student loans are essentially unsecured. No one's going to take your degree away from you if you don't repay your student loans, but you definitely should repay your student loans because there's a lot that could happen if you don't. And Kelsey and I will talk about that toward the end of the Get Savvy series in months from now. And then let's go to the next slide to thanks. Thanks for Andrea for reminding me what month that would be, in April. Yes. And let's talk about revolving versus installment. So your revolving credit, you essentially have a set amount of credit available. So I'm going to use a credit card, for example. You have a $3,000 credit limit. That's how much you always have available, and there's no end date into when you need to repay that full credit balance. So your credit cards, home equity lines of credits, retail cards, secured cards, all considered revolving credit. Your installment credit is going to be something where you pay for a fixed amount of time and then it's all done. So mortgages, your car loans, student loans, business loans, those you all will pay in installments until they're over. And now this is a chart that I made very sloppily and Andrea made very pretty. So I want to talk a little about the path to getting credit. So if you're going to establish credit, there's a couple ways to do it. One, you could become an authorized user, and Kamaya talked about this a little bit earlier. That is when someone allows you to be a user on one of their credit products, and you can then inherit that credit history. Or you could submit an application. And if you are approved, great, you start building credit history there. If you are denied, you could look at a couple of different options. You could potentially look for a cosigner, which again, Kamaya talked about to help secure more faith from the lender that that loan will be able to be paid back. Or you could look into a secured credit card or a secured credit product, whereas you will have that collateral. So for a secured credit card, you're essentially giving a deposit, and then you would be given a credit card, sometimes with that deposit at the credit limit, sometimes a little bit higher, depending on the specific product. I want to transition into the scoring models a little bit and how these different scores are calculated. So FICO is the main kind of the most commonly used scoring model, but Vantage scores are also out there as well. And they use very similar but slightly different ratios of things that they're looking at. So starting with the FICO and also with the Vantage, the biggest chunk of your score in both cases is going to be your payment history. And that's you paying your bills at least on time every month. So you could pay early and that's still considered good payment history. FICO isn't necessarily preferred. It's just kind of the most common. It's been around a little bit longer. It's kind of the more industry standard. So I'm sorry, I'm used to like responding to chats as well, but I will let the people in the chats respond to the chats. Sometimes I'm doing these webinars by myself and I have all of it to do. The next factor, you have your amounts owed with the FICO score, and you'll see that in the balances column on the Vantage score. You have your length of credit history, which is 15% over on the FICO score, and that has a little bit more of a impact with that depth of credit that they're talking about in the Vantage score. The new credit on FICO is recent credit applications. On Vantage, again, little bit different weight there. And then a credit mix, which also with FICO, that's like a mix of your secured and your unsecured, your installment and your revolving credit. And that's more in that depth of credit section with Vantage. So very similar profiles, but slightly different weight that they're using in those scoring models. When we talk about what those ranges of the scores actually look like, and again, This is primarily using that FICO score model because, again, it's used by lots more lenders, so it's what we talk about most commonly. But this gives an idea of kind of where those credit score ranges might be. And one thing that's important to think about when you're looking at your score range is if you are applying for new credit, so if that is a credit card or a mortgage or a car loan or whatever that might be, knowing where you sit is going to be very advantageous as far as being able to predict what rates you might be offered and also know if you're getting offered a rate that makes sense for your credit score or not. So having a good idea of where this all comes from is really important. Now, as you make potential mistakes with your credit, this can be really impactful on your score. So again, this is using information from FICO. But one thing we see on this chart is it's kind of the bigger you are, the harder you fall kind of thing with these different scores. So the higher your score is, the more negative impact a negative behavior could potentially have on that score. And I always think about it this way. Your credit score is there to predict how likely you are to repay your debts. And that means your creditors have this opinion of you and they say, this person is really good at paying their debts back. And if you do something that shows them that you're not potentially as good as paying those debt back, that opinion of you changes drastically. Whereas if you're already in that middle range and they're like, they might be good, they might not be good, I don't know. And then if you do something that's not as good, it doesn't impact that opinion of you as much. I always think about it when you loan your friends money and they suddenly are usually paying you back and then they suddenly don't, it changes your opinion. And I would agree a lot about the credit system doesn't necessarily seem fair, but this is the system we're working within and we have to know the system so we can use it to our advantage. So just thinking about how those behaviors can impact that score is certainly something to be aware of. Looking at the Fair Credit Reporting Act. So this really makes sure that the accuracy, fairness, and privacy of your information is kept in a fair and protected way. So this information could be from the credit bureaus, different consumer reporting agencies, and specialty agencies. And you have a right to understand this information, and this information should be protected. So you want to make sure, again, that it's accurate, that the information on your credit reports are accurate, and that you are disputing it if it is inaccurate. But you want to make sure that that information is right, accurate, and private for you. So really quickly, thinking about a couple more factors that can lower your credit score. So, and this really kind of follows from what we were talking about with those FICO and Vantage scoring models. Unpaid or late payments, that impacts those biggest chunks of your score, that payment history. When you are closing your accounts, again, that's something that came up a lot. It depends on the other credit mix you have, the age of the accounts, the available credit on those accounts, that can potentially lower your score. Inactivity can potentially lower your score. And I haven't seen this happening too much recently, but there are some times when a creditor might, particularly with a credit card, send you a letter that says, hey, you haven't used this card in 9 months. We might close it. And that doesn't happen as often as it used to, but I have still seen that happening sometimes. High credit utilization. So again, being too close to your credit limits, that can certainly lower your score. And then having too many credit applications at once. So multiple hard inquiries can definitely lower your score a little bit as well. Going into those hard and soft inquiries just a little bit more. Again, those hard inquiries are a record of that consumer actively seeking credit. It influences those credit scores with that new credit piece. And they do pool similar types of hard inquiries. So let's say that you're thinking about getting a car loan and you are going to be looking at multiple car lenders. they will kind of pool those hard inquiries if you do them within a short period of time. Your soft inquiries, those are again recording you checking your own credit or those pre-approvals or the lenders that you already have relationships with, and those do not impact your credit scores. And I know we're getting close to the end. We've had so much information, and I'm going to turn it back over to Kamaya to kind of close us out.
All right, thank you so much, Natalie. I'm back, y'all. Okay, so we're gonna just briefly touch on this because, like Natalie says, we've covered a lot, and I see that some people are running off. But when we think about like methods for establishing and building credit, true to like what we've been talking about with like that conscious credit focus is, what are some of the ways that you can start with that? And of course, when we're thinking about this, and I've worked with folks who are newly building credit or rebuilding credit and always looking for just ways or just encouragement on how they can do that. So for us, we provide the data and we also provide some other things as well too. Think about easing into it, starting out small, making sure that you're practicing like that self-discipline place. When it comes to with credit and managing that, sometimes that can be very hard. I like this idea about like adopting like a credit philosophy and whatever that could mean. It could mean you could even create a mantra. I know we have creative folks out there who do things like that, like to do that. So, what is your credit philosophy? What do you think about doing when you think about like managing credit overall? And we encourage that you avoid kind of like that maxing out like your credit card, because we talked about credit utilization and what that actually means. Monitoring like your activities, seeing if there's any abnormalities, if there's anything going on with your account, just paying attention to that. And it will be trial and error. So making sure that, if something goes wrong or you make a decision that you look back at and you're like, oh my gosh, why did I do that? So just learning from like that mistake and being patient, knowing that, for it will take time. And a lot of people take time. I've done programs with prison population, with release population, and a part of like the discussions that we've had too is a lot of people are coming out and trying to rebuild their lives, and credit is one of like those big issues that they've talked about. And so like having knowing that you have to be patient and that it will take time and it takes some due diligence and different things on our part to make sure that that actually happens. So I'm going to just ask Natalie to talk briefly about the Experian boost. So we'll skip this one and then ask Natalie to talk a little bit about that so that folks can and hear about this before they have to jump off.
Sure, and I forgot for a second that I was coming back, but I'm back for a sec. So the Experian boost and UltraFICO scores, things that have come open a little bit more recently to help usually people with thinner credit files get a little bit of a boost, to be really literal, or a little bit of a push or an increase in potentially in their credit scores. So what Experian Boost does is it uses your payment history on things like rent, phones, and utilities to increase that Experian score. Your UltraFICO, rather than looking at that kind of different payment history, actually looks at your banking behavior. So they'll look at you if you're not overdrafting your account, if you have a good amount of cash on hand, if you have a nice length of banking history. Both of those things can kind of impact your credit scores potentially. Both the Experian Boost and UltraFICO do require a link with your bank account to get going. So if that's something that you're a little bit hesitant about, it's something to kind of think about before using those different products. And I will say that while these are definitely created to increase people's credit scores, I have occasionally seen people's credit scores decrease after using Experian Boost or UltraFICO. So you really do want to make sure that what they're looking for is going to have a positive impact on you rather than a negative impact. And I was wondering if anyone has heard of these today or maybe has any experience using either Experian Boost or UltraFICO. And while those are coming in, I will turn it back over to Kamaya. Thanks.
Thank you, Natalie. So we've been talking a lot about like consumer rights and protections, and of course having like a good credit rating is very important, but also knowing where to find like accurate information or where to obtain like your credit report. And as we mentioned before, they're available now weekly just to check like that information. I want to jump to just talking about like managing credit during this time during COVID-19, because as we're all trying to figure out like how we're managing like our debt, managing other things that we have going on, what are some of the protection or provisions that are in place right now that could possibly help us with managing like our debt. And a number of lenders, in accordance with some of the thing that's been happening with the CARES Act, like a number of lenders, of course, are providing opportunities to help their customers to make just adjustments or accommodations for their customers during this time. Like not necessarily required, but definitely trying to help their customers with like the payments and offering just like different kind of assistance or relief program that could be helpful during this time. So we advise you to definitely contact your lenders. And as you're contacting them, the Consumer Financial Protection Bureau has like a number of important resources for you. They also have just even like some questions that you can ask when you are inquiring about like what your lenders do have in place right now. So just questions about, during this hardship period, if you want to go to the next slide, please, like during this time, is there any fees that they have to pay? What accommodations they will be making for you? So just having like different questions. So we want to provide that resource for you just to let you know. And while some lenders might be making some accommodations, not everyone is doing that. So if you do have kind of like an agreement or an accommodation with like your lender, just knowing like what their responsibilities are for reporting your information. So if you want to move to the next slide, I'm jumping through here. Going a little bit fast, but we'll have like some of this information resource for you, definitely. So with like your lenders, so some of them again you might have an agreement with them. So if your account is like current and you're making payment, they of course must report like all your on-time payment and all of that to like the credit reporting agencies. If you are already delinquent on like your account, they cannot add additional things if you do have like that agreement, and that agreement might go till the end of the year along with the CARES Act, or it might be different. So every lender might have like a different type of agreement with your customers. If you have no agreement with like your lender, they're like, nope, I know this is a very hard time for a lot of people. I know unemployment rate is high, but we cannot make any accommodations right now. So if you have no kind of agreement, just knowing that not paying on these loans will definitely affect like what's being put in your credit report. But on the other side, a little bit of good news is that there are different types of comments that you or your lender can place on like your credit report, just to highlight that you are having a hard time due to the national emergency due to the pandemic. So you can put like what they call like a special comment on there, and that's just a request that you can place on there, and that just notes that because of like the national emergency due to the pandemic, you will not be able to make certain payments. So of course, even though that comment won't affect like your credit score, it just puts a note on there to prospective lenders, so that if they go in and they see that, they know that it's because of like this hardship situation why you weren't able to pay your bills on time or get all of that taken care of. And then of course there's another one called the permanent comment. And this one is similar to the special comment, but this one will stay on even after kind of like the national emergency situation is over. But I just wanted to touch on that just a little bit about what will happen, what can happen if you have an agreement with a lender or if you do not have an agreement with them. I'm going to jump towards the end. We have like different ways that you can actually monitor your credit activities, and we wanted to include this. It's a ton of information that we provide, and we want you to know that there are different ways that you can manage like your credit cards, your other financial accounts, and finding like a method that works great for you. For some of us, we're always on our phone, or a phone feels like it's our life and we have it right there. So making sure that you're using a system that works for you. If mailing in like your statements from your agent from your different accounts, if you want to have like those like hard copy statements, lots of places still do those. So just like finding different ways in how you can monitor like your information, just to see if you see any kind of discrepancies, or you see people using like your information wrongly. So just making sure that you're monitoring like your different account activities. All right, so it's been such a wonderful time talking about this. Thank you all for being on. As I babble through some of this, I have some resources on here. A lot of what we pull is from the Consumer Financial Protection Bureau and also from the FTC, and we've been sharing a number of resources in the chat. I have a quick poll for those who are still on. I know a lot of our people jumped off, but for us, within University of Illinois Extension, we get funding from a lot of different ways, and one of those ways to provide like free educational program. And we would definitely like to just hear from you. And one of our questions that we're asking today is about your race. So part of this is part of our funding efforts to offer free and available programming for you. So if you would like to enter that information on what race you are, that would be very helpful to us. Well, thank you all. So just in summary, I'm going to quick go over just like a lot of stuff that we've talked about. So I appreciate you all being on, and those who have hung on with us to the end. Yay. Awesome. So some big takeaways: credit is complicated, and it really does help when we can understand how the credit system works and develop like our knowledge on how to navigate it. Just knowing that there are different responsibilities within that system, and you as the person who is borrowing that money, what is your responsibility? What is your responsibility to yourself, to the lender, and to your co-signers that might sign on for you? Definitely trying to avoid like some of the myths associated with like credit and credit management. That was a great activity that Natalie put on. So just looking at your credit scores, your and your credit reports, just to make sure that the information that you have on there is accurate and it's up to date, and taking like that time that you need, knowing that it will take time to build credit. So if for some people who are starting at different points, it might take time to build that credit. And also knowing that during this time, you might have some options. I know the end of the year is right around the corner, but just knowing that you have some options during like times of hardship to contact your lender and find out as much information as you can from them about how they might be making like any accommodations for you. It's been my pleasure to do this with Natalie. I know we have a few different things on there. Andrea, do you want to talk about like our last slide?
So we have another webinar. Our next webinar coming up is in 2021 on tackling taxes. So if you are just overwhelmed with taxes, we're going to be trying to break down some of the basics of getting organized for taxes and some of the terminology for it. So put that on your calendar, and you can register at the link that Kendra just shared in the chat.
Thanks, Andrea. Any last questions? Natalie, any final thought?
Just want to say a big thank you to everyone for being here.
We appreciate you being on, and we appreciate all our co-hosts who are answering questions in the chat. That's always very helpful, and a lot of participation from everyone that was on. We really appreciate it, and we look forward to seeing you on the next one. Thank you.